When you look at markets going forward, how much of it will be earnings and how much of it is it, once again, just monetary policy?
Well, I think actually it's a bit of both. So as of December, the Fed gave the green light to markets, really, that it wasn't going to react to a loosening of financial conditions and try and offset it. And that's been behind, I think, much of the pickup since December in the S&P. But now we're seeing a bit more focus on earnings as well. And I think what's really interesting is that even though earnings have been reasonably resilient overall, we're seeing quite a lot of dispersion, even within the Magnificent Seven. And for us, this is an environment where actually selection is more rewarded than it used to be in the past. This isn't a sort of macro environment in which the rising tide lifts all boats.
So why is that? And actually, how, again, is this because the environment, especially on the use of AI, is very much how the chief executive or management team apply to it?
Yeah, absolutely. I mean, on AI, our thinking is that this will broaden over time from being about chips originally, to being about the producers of the AI technology, to actually ultimately being about which companies far outside the technology sector can actually implement AI solutions to gain a competitive edge. And that's really, again, where careful selection comes into play.
So, Alex, is it in the next 12 months that we found out? I mean, I know you don't talk specifically about stocks, but the general idea is that if you look at some of the valuations, they probably won't stay at $2 trillion. They're either go to $5 trillion or actually go down.
I think we could see quite a lot of move over the next year, actually. And, right now, because the Fed's given this green light to financial conditions, and we'll see what they say later, we're overweight broad US stocks. But actually within that, this tilt towards AI-related exposures is more important. And as we go through the year, we could get a more complex environment because it's likely that central banks will be a bit more cautious in reducing rates than markets are currently pricing. And it's clear that we're not really going back to how things used to be. Rates aren't going back to kind of great moderation levels.
Which the market is not pricing in yet.
Not yet. I think it's pricing quite a few cuts this year still, though. And, it'd be interesting to see from the Fed in particular later, does it stick with its view that maybe 3 cuts this year looks about right? In our view, that looks about right. Or does the market stick with its view that something closer to 6 is about right?